Billionaire Ray Dalio just called it an economic heart attack. In July 2025, the founder of the world's largest hedge fund issued a warning that should terrify anyone holding dollars. The United States has entered phase 5 of the big debt cycle, where debt becomes so massive that even central banks can't service it without destroying the currency itself. And while most people are ignoring this, the ultra-wealthy aren't debating whether it's coming. They're positioning for it right now. Here's what should wake you up. Gold hit $4,236 per ounce in October 2025. That's not a typo. The yellow metal everyone called a barbarous relic has surged 60% in a single year. But this isn't jewelry demand driving prices. Central banks are buying gold at levels not seen since the 1970s, the last time a global monetary system collapsed. They know something. And the billionaires watching central bank behavior know it too. The US dollar just had its worst year in over a decade. The dollar index collapsed nearly 10% through September. Against the euro, down 13.5%. Against the Swiss franc, down 13.9%. Even against the yen, which Japan has been desperately trying to weaken, the dollar dropped 6.4%. This isn't normal volatility. This is structural breakdown. So what are the wealthiest people on earth doing about it? Not hoping, not waiting, not trusting that someone will fix it. They're making 3 specific moves, the same 3 moves that have protected wealth through every currency collapse in history. And here's what matters. You don't need to be a billionaire to make these moves. You just need to understand what they are and why they work before everyone else figures it out. Let me show you exactly what's happening and what you can do about it. Move number 1. Hard assets, specifically gold and precious metals. Ray Dalio has been crystal clear about this. He recommends 15% of your portfolio in gold, not as speculation, as insurance against the exact scenario we're entering right now. His logic is simple. Gold can't be printed. It's not tied to any single country or economy. And it's the one asset that rises when everything else falls. Look at what's actually happening. Gold has skyrocketed 750% over the last 20 years. But the acceleration is recent. In 2025 alone, gold prices jumped more than 50%, while stocks struggled and bonds got destroyed. Why? Because smart money sees the math. US debt exceeds $38 trillion. Interest payments alone cost over $1 trillion per year. That's 17% of all federal spending going just to service existing debt. There's no way out of this without currency devaluation. You can't tax your way out. You can't grow your way out. The only option is to inflate the debt away, which means destroying the purchasing power of the dollar. Colin Plume, CEO of Noble Gold Investments, put it perfectly. Central banks use gold to hedge the wealth of their country. Billionaires use gold to hedge their billions. What are you using to hedge yours? But gold isn't the only metal that matters. Silver offers something different. It's more affordable for smaller investors, which means you can accumulate more ounces. It has industrial demand, which creates price support beyond monetary value. And it's more volatile than gold, which means bigger potential gains during precious metals bull markets. Many experienced investors use a 70-30 split. 70% gold for stability, 30% silver for upside. Analysts expect gold to hit $4,400 to $5,000 per ounce in 2026. That's not speculation. That's based on central bank buying patterns, geopolitical instability, and the mathematical reality of unpayable debt. Goldman Sachs research identified gold as the best commodity to hedge against inflation and geopolitical risk. When Goldman Sachs tells their wealthy clients to buy something, it's worth paying attention. Real estate represents the other critical hard asset. Property has preserved wealth through every currency collapse in history because it has intrinsic value. People need shelter regardless of what happens to paper money. But not all real estate works the same in a currency crisis. You want income-producing properties where rents adjust to inflation. Commercial real estate with leases tied to inflation indices. Land in growing areas that will appreciate regardless of currency value. The numbers tell the story. The median US home price went from $63,700 in 1980 to $347,500 in 2021. That's a 550% increase. Meanwhile, the dollar lost most of its purchasing power. Real estate didn't just keep up with inflation, it crushed it. And unlike stocks or bonds, real estate generates cash flow, rental income that rises with inflation while your mortgage payment stays fixed. That's wealth protection and wealth building simultaneously. Hard assets work because they have value independent of any currency. A gold coin is a gold coin whether the dollar exists or not. A property generates rent whether the government pays its debts or not. This is why every wealthy family throughout history has held significant portions of their wealth in physical assets. It's not old-fashioned, it's proven. But here's what most people miss. Hard assets alone aren't enough. Because if all your wealth is in one country, one currency zone, one economic system, you're still exposed to catastrophic risk. Which brings us to the second move billionaires are making right now, and it's one that most Americans never consider. They're diversifying geographically and across currencies. And the scale of this shift should terrify anyone who thinks the dollar's dominance is permanent. China's foreign exchange reserves tell a story most Americans don't know exists. In 2010, 40% of their reserves were in US Treasury holdings. By 2025, that number dropped below 1%. They didn't just reduce exposure, they systematically dismantled it while building alternatives. And they're not alone. The IMF estimates that 30 to 40 non-aligned nations hold more than 10% of their reserves in dollar-denominated assets while simultaneously facing US sanctions exposure. These aren't enemy states, they're neutral countries watching what happened to Russia's frozen dollar reserves and thinking, we could be next. When your reserve currency becomes a geopolitical weapon, everyone starts looking for exits. Foreign investors are actively diversifying away from dollar concentration. Central banks worldwide are reducing US Treasury holdings. Nations are spending on domestic economies in ways that repatriate assets back home. This isn't theory, it's happening in real time, and the velocity is increasing. JP Morgan, managing wealth for the ultra-rich, recommends building toward 30% non-dollar exposure. Their suggested allocation? The largest portion goes to euro-denominated securities, followed by gold, Japanese yen, and British pounds. They're not guessing. They're modeling their recommendations on what central banks actually hold, institutions with infinite time horizons, and one primary objective: preserve purchasing power. Why does geographic diversification matter so much right now? Because historical patterns show international equities crush US markets during dollar decline cycles. Ray Dalio observed that investors would have rather been in non-US stocks than US stocks, non-US bonds than US bonds. The numbers prove it. European equities outperformed US equities by 23% during the recent dollar weakness, Chinese equities by 21%, UK equities by 19%. Emerging market equities delivered 34% returns. That's a massive wealth transfer from the United States to other regions, and currency translation effects amplified every percentage point. When the dollar has been extremely overvalued historically, it tends to decline at an average pace of 2.6% annually over the following 5 years. If that pattern holds, international investors get years of currency tailwinds on top of underlying market gains. Your international investment doesn't just need to perform well. The currency exchange adds another layer of return. But most Americans never consider the simplest geographic diversification move: opening a bank account outside the United States. This gives you the ability to hold deposits in other currencies: Swiss francs, Singapore dollars, Norwegian kroner, currencies backed by countries with actual fiscal discipline. It's insurance. If something happens to the dollar or the US banking system, you have options. Your wealth isn't trapped in one jurisdiction, one currency, one system. Foreign real estate takes this further. Property in stable countries acts as a physical safe haven, somewhere you can actually go if things deteriorate domestically. Several residency programs are accessible for $100,000 to $200,000. You're not just buying property, you're buying optionality, access to different economic environments, protection against country-specific crises, a second passport in many cases. Second residency programs offer unique benefits as hedging instruments. They let you access different currency zones, different legal systems, different banking regulations. When one country implements capital controls, you're already established elsewhere. That's not paranoia. That's how wealthy families have protected themselves for generations. The third move billionaires are making involves restructuring portfolios around inflation-protected securities and alternative assets. Ray Dalio stated clearly, the safest investment you can get right now is an inflation-indexed bond. Treasury inflation-protected securities, known as TIPS, have principal values that rise with the consumer price index. You're getting a real return above inflation, backed by the government. When currency devalues, your principal adjusts upward automatically. TIPS are accessible through Treasury Direct or any major brokerage. They're not exotic. They're straightforward protection that most investors completely ignore while chasing yields that inflation will destroy. Dalio's investment philosophy centers on uncorrelated return streams, his holy grail of investing. Find 10 to 15 good uncorrelated return streams, assets whose returns don't depend on one another. This approach lowers risk by 80% while maintaining average returns. You're not putting everything in one basket. You're spreading across assets that respond differently to the same events. Gold and Bitcoin both fall into this category of uncorrelated assets. When stocks drop, gold often rises. When currencies weaken, Bitcoin sometimes surges. The correlations aren't perfect, but that's exactly the point. 15 uncorrelated streams create a portfolio that can weather almost anything. Commodities beyond precious metals provide additional protection. Energy has historically generated the strongest real returns when inflation surprised to the upside. Oil products remain crucial for consumer prices. Natural gas offers significant hedging benefits. Agriculture and livestock rise during supply shocks and demand shocks. Industrial metals protect against demand-led inflation through exposure to manufacturing and housing. A 1% surprise increase in US inflation has historically led to a 7% real return gain for commodities. That same inflation trigger caused stocks to decline 3% and bonds to drop 4%. Commodities don't just keep pace with inflation, they accelerate past it. Bitcoin and cryptocurrencies represent the highest risk, highest potential return option. Iran's current crisis demonstrates Bitcoin's value as a hyperinflation hedge. 22% of Iran's population, 10 million users, adopted cryptocurrency despite government restrictions. When your national currency collapses and the state controls banking, Bitcoin's decentralized nature becomes survival, not speculation. A single Bitcoin went from 8 cents in 2010 to $33,000 by 2021. That's over 412,000% growth. The volatility is extreme, but for those willing to accept risk, the inflation protection potential is unlike anything else available. These three moves work together. Hard assets anchor your wealth. Geographic diversification protects against single country collapse. Alternative assets and inflation-protected securities provide growth and purchasing power preservation. Separately, each strategy offers partial protection. Combined, they create a fortress around your wealth that can withstand currency collapse. The critical factor isn't perfect execution, it's action. Most people understand these concepts, but never implement them. They analyze endlessly, research thoroughly, and never pull the trigger. The billionaires making these moves aren't waiting for perfect timing or complete certainty. They're acting now, incrementally, consistently. Start with what you can control today. If you have savings sitting in a traditional bank account, losing purchasing power to inflation, move a portion into tips through Treasury Direct. That takes 30 minutes. If you're entirely concentrated in domestic stocks and bonds, open an international brokerage account and allocate 10% to foreign equities. That's an afternoon of work. If you own zero physical gold, purchase a small amount from a reputable dealer. 1 ounce, half an ounce, whatever fits your budget. The amount matters less than establishing the position. Dalio recommends holding a portion of capital in cash or short-duration instruments specifically to capitalize on emerging opportunities during market dislocations. When panic hits and assets get mispriced, you want dry powder available. Keep near-term cash needs in treasury bills, treasury-only money funds, or insured deposits. Don't park operating cash in assets that could gap down on headlines. Liquidity provides optionality when others are forced to sell at the worst possible moment. The warning signs are accelerating. Expanding government deficit spending without corresponding economic growth. Central bank balance sheet expansion through continuous asset purchases. Declining currency exchange rates against stronger currencies. Rising prices for essential commodities like food and energy. The velocity of money increasing as holders rush to exchange currency for goods. Growing disparity between official inflation statistics and what you're actually experiencing at the grocery store, the gas pump, in rent payments. Dalio compared today's environment to the early 1970s. Inflation, heavy government spending, high debt loads eroding confidence in paper assets and fiat currencies. We know how that decade ended. Gold went from $35 an ounce to $850. The dollar lost half its purchasing power. Those who understood what was coming and positioned accordingly preserved wealth. Those who trusted official narratives and stayed in cash got destroyed. Germany's post-World War I currency collapse followed a predictable pattern. Steady rise from 1918, then exponential surge as reparations and money printing eroded value. The peak chaos required wheelbarrows of cash for a loaf of bread. That's not ancient history. That's what happens when governments prioritize short-term political survival over currency stability. The mechanics repeat because the incentives never change. Dalio recently stated he's worried about a breakdown of the global monetary order. He's more concerned about trade disruptions, mounting US debt, and emerging world powers, bringing down the international economic and geopolitical structure that's existed since the end of World War II. This isn't speculation from a blogger or a commentator. This is the founder of the world's largest hedge fund, managing $130 billion, warning publicly about systemic collapse. Gold hit $4,236 per ounce in October 2025. That's not a typo. Analysts expect prices to reach $4,400 to $5,000 through 2026, driven by central bank purchases, geopolitical uncertainty, and safe haven demand. Gold has surged 60% over the past year and 750% over the last 2 decades. Central banks are buying at levels not seen since the 1970s. They're not buying because they think everything is fine. They're buying because they see what's coming. The US dollar index fell nearly 10% through September 2025. The dollar depreciated 13.5% against the euro, 13.9% against the Swiss franc, 6.4% against the yen. The world's reserve currency is on track for its weakest year in more than a decade. China reduced treasury holdings by nearly $200 billion over 3 years while accelerating gold purchases. Foreign central banks are diversifying away from dollar-denominated assets at an unprecedented pace. When your largest creditors stop buying your debt and start buying gold instead, that's not a warning sign. That's a siren. The United States has entered phase 5 of the big debt cycle, according to Dalio, where debt becomes so excessive that even central banks can't service obligations without devaluating the currency itself. US public debt exceeds $38 trillion. Annual interest costs surpass $1 trillion, consuming 17% of total federal spending. At current trajectories, we'll be spending more on interest than on the entire military within 3 years. There's no political will to cut spending, no ability to raise taxes enough to matter. The only option left is currency devaluation through inflation. That's not a prediction. That's mathematics. You cannot wait for official confirmation that the crisis has arrived. By the time governments admit currency collapse is underway, capital controls will already be in place. Bank withdrawals will be limited. Foreign exchange transactions will be restricted. Asset prices will have already adjusted. The window to protect yourself closes before the announcement is made. The billionaires aren't moving because they have inside information. They're moving because they understand history, mathematics, and incentives. They know governments always choose currency devaluation over default. They know central banks always choose inflation over deflation. They know the political class always chooses short-term survival over long-term stability. These aren't conspiracies. They're patterns repeated across centuries. Your advantage is that you're seeing this now, before the majority acts. The strategies outlined aren't complex or exotic. Physical gold, international diversification, inflation-protected securities, uncorrelated assets. These are established, proven methods used by wealthy families for generations. The only question is whether you'll implement them before everyone else figures it out. The next crisis won't announce itself with a press conference. It'll arrive overnight, on a weekend, when markets are closed and banks are shut. You'll wake up Monday morning to new rules, new restrictions, new realities. The people who protected themselves beforehand will be fine. Everyone else will spend years trying to recover what they lost in a single weekend. That's how currency collapse works. That's why billionaires are moving now. They're not panicking. They're not rushing. They're methodically building positions while assets are still available, while borders are still open, while capital can still move freely. Because they've studied what happened in Weimar Germany, in 1970s America, in Argentina, Venezuela, Zimbabwe. They know the playbook. First, the warnings that nobody heeds. Then the acceleration that catches everyone off guard. Then the moment when it's already too late to act. You have a choice right now that won't exist much longer. Position yourself on the side that understands what's coming, or stay with the majority that trusts official reassurances until the day those reassurances prove worthless. The billionaires making these 3 moves aren't smarter than you. They just have more experience watching governments lie about currency stability right up until the collapse. They've seen this movie before, and they know how it ends. The math is clear. The debt is unpayable. The currency must devalue. The only question is whether you'll be holding hard assets, geographic diversification, and inflation-protected securities when it happens, or whether you'll be holding promises denominated in a currency that just lost half its value. Start today, not next month, not when things get worse. The window is closing faster than most people realize.